Money isn't just currency. It's the story of power. Welcome to Welixon. There's a pattern in history that has destroyed every global reserve currency. Not most of them, every single one. The Portuguese real dominated global trade for decades, then collapsed. The Dutch guilder ruled the roots in markets, then fell. The British pound reigned for more than a century, then died as a global reserve. Each followed the same 7 stages. Each believed it was different. Each was wrong. The US dollar became the world's reserve currency at Bretton Woods in 1944. That was 81 years ago. Right now, in 2025, the dollar is sitting deep inside stage 5 of the same 7-stage pattern. This is not prophecy. It's pattern recognition and arithmetic, a sequence that has repeated across centuries. The only question that matters is which judgment wins. Are we wise enough to see what's coming, or arrogant enough to assume the rules no longer apply? I'm going to walk you through the 7 stages every reserve currency goes through, what each stage looks like in real time, and exactly where the dollar sits today. This will be practical, not theoretical. It will map the past to the present, so you can see the channels where risk flows and where opportunity, or catastrophe, will show up next. Stage 1. Military dominance and control of trade routes. Every reserve currency begins not with a printing press, but with a battle fleet. Currency power is first a logistics and enforcement problem. Who controls the choke points of commerce? Portugal in the 1500s, the Dutch VOC in the 1600s, Britain in the 1800s. Each of them commanded naval power that made trade possible only on their terms. Control the route, control the price, control the currency. The logic is simple. If ships cross oceans with goods only because one navy allows it, merchants will prefer a currency backed by that navy's protection. The currency becomes the medium of exchange for that protected commerce. It's not magic, it's coercive advantage. The U.S. achieved this after World War II. American naval power, global bases, and the geopolitical architecture that followed created the conditions for countries to use dollars as the easiest, safest means to trade. Stage 2. Trade surpluses and accumulation of global wealth. A reserve currency nation doesn't just protect trade, it benefits massively from it. Portugal collected spice rents. Amsterdam captured arbitrage. Britain exported manufactured goods and extracted colonial returns. From roughly 1945 to 1970, the U.S. ran historic surpluses. European and Asian industrial capacity was wrecked after the war. America shipped machinery, cars, and consumer goods to a world that needed them. Dollars flooded foreign treasuries. The reserve nation accumulates claims on real production elsewhere. That accumulation is a major part of the ascendancy. Stage 3. Formalization of reserve status, the peak. At some point, markets say, we'll use your money. That formalization is the peak. For the U.S., that moment was Bretton Woods. Other currencies were pegged to the dollar. The dollar was pegged to gold, and global institutions created a rule set that institutionalized dollar demand. But this is also the inflection. Once the world depends on your currency more than your industry, the incentives flip. Stage 4. From exporter to consumer. Permanent deficits begin once reserve status is formalized. The reserve country faces a paradox. To supply reserves, you must send your currency abroad. That tends to create persistent current account deficits. A Triffin dilemma captures this. The world needs dollars, so the U.S. must run deficits. But running deficits undermines confidence in the dollar. Portugal, and later Britain, lived this reversal. The U.S. crossed into this stage in the 1970s after the dollar left the gold standard. Imports replaced exports as the engine of consumption, and trade balances shifted permanently. Stage 5. Currency debasement and money printing, the desperate measure. When deficits get large and political pressure mounts, the state chooses to avoid hard choices, taxes, cuts, or rebuilding competitiveness, and instead expands the money supply. Debasement is not only a literal cutting of metal from coins. For fiat systems, it's the rapid creation of currency. Britain did it after wars. The U.S. entered the era of massive monetary expansion in 2008, then again during COVID. Quantitative easing, balance sheet expansion, and sustained fiscal largesse are modern debasement. They preserve short-term functioning, but they erode purchasing power and international confidence. Inflation is the public face. The hidden face is declining reserve utility. Stage 6. Loss of confidence in the search for alternatives. Confidence is the fragile commodity that underpins reserve status. Once trust in the currency's purchasing power wanes, foreign treasuries, and central banks diversify. They buy gold, they increase non-dollar reserves, they settle trade in alternative currencies. This is not an ideological act, it's a portfolio decision. The Portuguese real lost acceptance. The guilder fell from grande distribution to regional memory. The pound ceded reserve share to the dollar over decades. Today the signs are distributional. Some central banks buy gold, some trade in alternatives, and geopolitical blocs explore non-dollar settlement systems. Diversification is gradual at first, then it accelerates. Stage 7. Replacement and collapse. Replacement is rarely violent in the classic sense. It is a market migration. Trade contracts and central bank balance sheets reorient. A new anchor, another currency, a commodity standard, or a supranational mechanism takes the role of the old. Once a reserve currency reaches stage 7, its global utility declines rapidly. Domestic consequences can be catastrophic. We've seen it before. Empires retreat not because cannons failed, but because the financial plumbing moved away from them. Where the dollar stands today, by watching these stages across history, the uncomfortable conclusion is that the dollar is in stage 5. The U.S. has completed stage 1 through 4. Military preeminence? Check. Trade dominance in the post-war era and the formalization at Bretton Woods? Check. The shift to consumption and persistent deficits? Check. Today, the Federal Reserve's balance sheet expansions and multi-trillion-dollar fiscal support packages reflect stage 5 mechanics. Using money creation to sustain an economy that has structural imbalances. That's the technical label. The practical outcome is the slow erosion of purchasing power and the beginning signs of stage 6. Reserve diversification, strategic non-dollar settlements, and central bank portfolio reallocation. Concrete signals the world watches. If you want to read the scoreboard, here's what matters. Reserve composition. A falling share of dollar reserves is a clear, measurable sign. A modest percentage change represents trillions reallocated over time. Central bank behavior. Buying gold, increasing the share of another currency, or bilateral currency swap lines are early-stage steps. Commodity invoicing. Oil and other commodities denominated in alternatives to dollars, even as contracts in yuan or other units, indicate structural migration. Sovereign debt dynamics. When foreign holders reduce treasury exposure or shift maturities, that changes yield dynamics for the issuer. Domestic policy choices. Persistent fiscal deficits financed by central bank accommodation are textbook stage 5 behavior. The logic of replacement. Why would another currency replace the dollar? Because markets prefer stability and liquidity. If a new payment network or a rival currency provides comparable liquidity with fewer long-term inflation risks, markets shift. But replacement requires infrastructure, deep capital markets, legal certainty, and geopolitical reliability. These are not trivial. That's why reserve turnovers are historically slow. Inertia favors the incumbent. Yet inertia is not infinite. Once a new set of institutions, a large trade bloc, a commodity-backed arrangement, or coordinated central bank swaps rebuilds the plumbing, allocation decisions accelerate. What collapse looks like in real-life collapse is not a single dramatic event, rarely a single doomsday. It often appears as a sequence. Rising yields on sovereign debt, higher import costs, capital flight, currency depreciation, and then political strain. Politicians react with price controls, export restrictions, and capital controls. The economy can enter painful adjustment. In earlier eras, empires resorted to extractive measures. Modern states leverage policy, inflation tax, financial repression, regulatory interventions. The social effects can be severe. Stagnation, reduced living standards, and political polarization. What you should do. Practical, not prescriptive. This is not financial advice. This is a framework to inform judgment. To understand exposure. How much of your savings, income, or business is tied to dollar-denominated assets? How much is tied to imports priced in dollars? Diversify thoughtfully. Consider real assets, foreign currency exposure, and assets that preserve purchasing power in inflationary regimes. Real assets and productive enterprises tend to hold value when fiat purchasing power erodes. Watch institutional flows. Central bank reserve changes, foreign official actions, and major sovereign buyers are leading indicators. Maintain liquidity and options. Periods of dislocation favor those with liquidity and the ability to act decisively. Study the signaling. Policy shifts like debt monetization, large-scale reserve diversification, or the breakdown of stable trade invoicing are casting votes about the future. Why this matters for you right now. Reserve status determines more than macroeconomics. It structures corporate supply chains, national security choices, pension returns, and the baseline of price expectations in households. When a reserve currency weakens, you feel it at the pump, the grocery store, and on your mortgage. It matters to retirees, companies with global supply chains, and countries with heavy dollar exposure. A short historical case to ground the abstract Portugal's early rise is instructive because it shows how structural advantage can ossify into complacency. Portuguese trade surpluses made Lisbon fabulously wealthy. That wealth reduced incentives to industrialize at scale. It created dependency on easy rents. When the mines or prices shifted, there was no productive backbone to sustain global relevance. The currency's fall was not sudden in institutional terms, but markets reallocated away from the real. The political center faltered. National power followed. The British example is equally instructive but modern. Global naval power, a dominant industrial revolution, capital exported worldwide, and a pound that became a global medium, and yet debt, world wars, and the slow loss of productive leadership pushed the pound from the center. The US has unique strengths: an unmatched capital market, deep corporate sector, technological leadership, and a still dominant financial ecosystem. That's why replacement, if it happens, is likely to be slow. But slowness is not safety. The economic cost of Stage 5 policy is that living standards erode quietly before the political reaction. The geopolitical dimension, why it's not just economics. Currencies are geopolitical instruments. Reserve status provides leverage over sanctions, trade terms, and capital flows. Losing or even sharing that leverage changes geopolitical calculations. Nations hedge by building alternative payment rails, creating swap lines, and settling trade in local currencies. The more geopolitically coordinated the alternatives become, the faster the shift moves from margin to mainstream. A realistic timeline and uncertainty no model gives you a calendar. History gives you sequences. The length of a stage can be decades. The shift from pound to dollar happened over 15 to 20 years. The Portuguese story unfolded over generations. The question is not if, but how fast and how disruptive. Technological leaps, political shocks, or surprise alliances can accelerate the timeline. Conversely, policy corrections, credible fiscal consolidation, or renewed export competitiveness can slow or reverse the momentum. A final clarity on probabilities, not predictions. This narration is about structure. The math says reserve status is a temporal phenomenon. The pattern is robust. The dollar's current position in Stage 5 implies elevated probability of Stage 6 dynamics over the medium term. That does not mean collapse next month. It means planning and awareness are prudent. Outro. Why you should subscribe to VisualEconomics if you want to follow the real currents of history, not headlines, not cheerleading. Subscribe. We trace money to power, and power to outcomes that shape your life. What you can buy, who controls supply chains, how governments respond in crisis. We break down the mechanics that the financial press ignores and connect the dots from policy to pocketbook. Subscribe to VisualEconomics for frameworks that turn noise into signal, so you can act before the story is written on the balance sheet.